So we are moving over to your Learning Unit 3, which is our VAT chapter. So you can see it's called Value Added Tax and Source Documents. Very practical chapter. You are required to do quite a bit of calculations. Also some very important theory. So what I've tried to do for my way of summarizing this learning unit is to just outline some of the more important aspects and some of the aspects that I've experienced students struggle with sometimes. So you definitely please still need to, I want to say, firstly, go and look at all your lectures, make sure you attend your lectures, and then use this to supplement your VAT knowledge. Okay, so Learning Unit 3, Value Added Tax and Source Documents. Okay, so like I mentioned, the reason why I'm doing this learning unit in the way that I'm dealing with it is because of the fact that this learning unit forms some important building blocks for your learning unit 4 and moving forwards. Okay, so some of the aspects that we work with in learning unit 3 are critical for you to be able to understand your source documents, your unpacking your source documents correctly, and being able to complete learning unit 4 journal transactions. Okay, so I'm dealing with this specific to next learning unit. So if you are sitting with learning unit 4 and 5, you're battling with the VAT breakdowns, please come back to these slides, come and refer to them. I'm sure they will help you understand your learning unit 4 and 5 a bit better. Okay, so some of the important aspects in terms of VAT. So first and foremost, we get different VAT supply categories. Okay, so different categories that our VAT, I want to say, eligible items fall into. And we classify these categories by the goods, the items that we buy. Okay, so we get standard rated, we get zero rated, we get non-allowable items, and we get exempt supplies. Okay, so that's your 4 categories, non-negotiable. You need to know them, you need to understand them. And on the right-hand slide, I reminded you to please understand what the categories are for and what items fall into these categories. Okay, so standard rated are our everyday goods. So you buy your food in Pick n Pay. That's generally things that have a VAT percentage added onto them. And if we as a business buy them, we can generally claim the VAT back. Okay, so the 15% that we paid over and above what the price of the item actually should be, we can claim back the 15%. Okay, so standard rate items, we can claim the VAT back. We need to take 15% of the price paid for these items into account. So for now, I just want you to start viewing things with price, VAT, total price. Okay, so if you have a till slip or anything close by the last time you went and bought anything at a store, quickly take that, look at it, and see that it's actually got a breakdown. Okay, there are rand figures for everything that you bought. At the end, there should be some amount for VAT. So that's why I speak about VAT as a separate item almost on your till slip, just so that you can start becoming aware of VAT as a standalone item that we deal with. Okay, reason being we deal with it separately is because remember, we have to pay SARS. That goes to the South African Revenue Service. So it's not ours. So that's why we try to almost say, okay, what would we have sold the item for? We need to put VAT on, and that's the total price because SARS takes their cut. Okay, so back to my 4 categories. So the first category, I said we have standard rated items, typically things we can claim VAT back the VAT on. So again, let's use a simple example. I've bought some food items for 115 Rand. 15 Rand of that I'm going to be able to claim back from SARS, okay, because I'm a registered VAT business. Any other category we have, we can't actually claim back anything. Okay, so no VAT needs to be calculated. This is very relevant for Learning Unit 4. So those 3 categories are zero rated items, non-allowable items, and exempt supplies. The reason why I say that we're not going to claim back any VAT, so you don't need to calculate it, is because zero rated items have a 0% VAT rate, which means 0 means nothing. So if I buy fresh fruit and things like that, if I pay 15 Rand, there is 0 VAT. So there's no VAT I need to work out. So therefore, I don't need to calculate any VAT because I don't need to book any VAT in my records because there's nothing that I can claim back from SARS. So a bit of a technicality, a zero-rated item is a VAT item, just at 0%. Okay, take note of your textbook on the difference. Standard rated is a VAT item with a VAT rate of 15%. Okay, so both of those, just maybe highlight number 1 and number 2, actually have VAT. One at 0, one at 15. Okay, so that's why the 15 one we'll calculate and we claim it back because we have actually paid for it. Okay, 0, we obviously effectively didn't pay anything. Then you get your third category, the non-allowable items. So these are the things that they have VAT on. We paid VAT for them, but we bought them, and SARS, they don't really regard these things as being very necessary for our business. So what they then say is, okay, well, you bought all of this, great, you can. We paid money, we book it in, it's fantastic. We can't claim the VAT back. Okay, which means we also don't need to work the VAT out because we can't claim it back. So why would we even work the VAT out to start off with? Okay, so your textbook breaks down non-allowable items for you in a bit more detail. So again, things that SARS in general, they don't regard as business expenses, they don't regard as necessary expenses. You can imagine otherwise businesses would claim back absolutely everything they buy. They obviously go quite excessive, buy quite fancy vehicles, send all their employees for weekly lunches, because everything that they pay, they can just get the VAT back. Okay, so things that are, I want to say, luxurious or not really necessary for the business, SARS regards as non-allowable, which means although we paid VAT, technically they look like standard rated. There are the kinds of items that SARS says, no, we can't claim the VAT back. Okay, and then lastly, you get exempt supplies. So exempt supplies are just literally things I always say that falls outside the VAT basket. So they don't have that. They're not registered. They're not VAT items. They're not VAT applicable almost. So again, also we obviously won't then work out the VAT. Okay, so that is on things that we buy. So we'll either pay VAT. We are then able to claim it back. So we'll work out the 15% so that we know what the 15% is that we are going to get back. If that item is zero rated, the VAT was 0, so there's no need to work it out. If that item was a non-allowable item, we also don't need to work it out because we're not going to get it back anyway. If that item was an exempt item, it has no VAT, so no need to work it out. Okay, so please familiarize yourself with the 4 categories, understand what they are, what items they have underneath them, so that when you come across you're buying apples, or you're buying milk, or you're buying brown bread, or you're buying a vehicle, you know exactly what category those specific items fall in. Okay, because you're learning unit 4 and 5 and carrying on further, they won't tell you, oh, you are buying fuel, and remember fuel is 0 rated. You need to know fuel is 0 rated. Okay, so that's the relevance of knowing and understanding these 4 categories. Okay, so just a reminder, that's why I said standard rated items, we can claim back the VAT. So that's why we work out the 15%. For 0 and non-allowable and exempt supplies, for different reasons, we can't get the VAT back. So that's why we don't need to work it out. Okay, that's on things that we buy in a business. When we move over to the section in red, there I am speaking about income made. Okay, remember, as a business, we are buying lots of goods in, we are then producing a product. Okay, so when we produce that product and we start selling it, SARS takes 15% on anything that we sell. Okay, so any income really. So any income on sales, any services that we offer. I mean, I might be a doctor or a dentist. I might not necessarily sell homemade products and cakes and rusks and things. So whatever income I produce, SARS wants 15% of that. Okay, so that's how they make their revenue. They take 15% of any sales for a business or any income earned in a business. So that's why when we decide on the prices that we are going to sell something for or offer a service at, I need to be mindful of the fact that if I say I'm going to offer a service at 200 Rand, SARS is going to take 15% of that 200. So that's why I should rather then offer the service at 230 Rand, because SARS will get 30, so I can still keep the 200. And that's why I say there at the bottom of the slide, we need to work out the VAT so we know what portion we need to pay over to SARS. So when we do the bookkeeping for any revenue, any income, we need to work out what is the 15% that SARS needs to get allocated for the service or the sale or this income that I've just made. Okay, practically speaking, previous slide I went on about the VAT categories, the VAT 15% that we need to take into account because we either need to pay it over to SARS or we need to claim it back from them. How do we work with this? Okay, so you get three different, I want to say, amounts when you work with a VAT calculation or with a figure with VAT. You get the figure with VAT in. Okay, and that's the VAT inclusive amount. So let's work with a round figure of something like 230. If that's got VAT in, your VAT will be 30 Rand. Your VAT exclusive amount will be 200. Okay, so you can see the relationship between the 200, the 30, and the 230. So the amount without VAT, so VAT exclusive, we refer to that as 100%. The VAT is 15%, so the amount with VAT in is 115%. Okay, so that 115,115 we work with quite a lot. Okay, so you should be able to know, if I tell you the amount is VAT exclusive, you should be able to tell me, okay, so that's 100%. That's without VAT. I still need to add VAT. If I tell you it's the VAT inclusive amount, you need to be able to tell me, okay, so I need to actually remove the VAT. So sometimes I'll also refer to it as adding VAT on or taking VAT off, okay, depending which of these three figures you have. There's an activity in your textbook that I'm sure your lecturer will give you to do that's very good to illustrate the relevance between these three figures and the relationship between exclusive, inclusive, and VAT. Okay, you need to know that they form one calculation. Okay, so 115, equals 15 and 100. Okay, so please work with these three numbers as a relationship to each other and not just separately. Okay, they do connect. So they are part of, I want to say, one equation or one calculation. Okay, so the amount without VAT plus VAT equals the amount with VAT. Okay, and the amount with VAT minus VAT equals the amount without VAT. Okay, so please take time to go over the difference between VAT inclusive, VAT exclusive. Okay, so towards the right of the slide, just again some terminology. If you are given figures and they tell you that VAT is already added, that means it's VAT inclusive. It means it's 115%. Okay. Any figure that they give you without VAT is VAT exclusive, which means it's actually equal to 100%. Okay, the reason why this is relevant is because you need to know how to get from VAT exclusive to VAT inclusive. You need to know how to get from VAT inclusive to VAT exclusive and work out the VAT, obviously, because the VAT is relevant, because the VAT tells us how much we need to pay over to SARS or claim back from them, depending if it was a purchase or an income. Okay, so that is why we need to be able to play around with these 115, 15, and 100%, so that we are able to say, okay, we can move ourselves from 100 to 115 or from 115 to 100 so that I'm able to work out the VAT so that I know how much I owe SARS or how much they owe me. Okay, so working out the VAT will be different because you don't always have the same value. Okay, so we sometimes have 115 Rand, 15%, sorry. We sometimes get 100%. So obviously, I want to say your base value is different. So you need to know, how do you work with the 100% that is given to you or the 115 to enable you to work out, I want to say, the figure that you need. Okay, so in general, and this is more for, I think, Learning Unit 4, when you start really working with transactions, you know, that you have to journalize and book in. So a bit of a general summary. So money paid, money received, any debtors, any creditor transactions will always be booked in VAT inclusive, which means 115%. Okay, and the reason for that is because what we receive or pay, depending if it's money going in or out, and depending if it's debtors or creditors, so people that we owe or owe us, that is the total amount that we owe. And that might also then be the total amount that they pay us. So some of what we owe or pay, some of what we receive is going to SARS. Okay, you might want to listen to this again, and I'll say it again. So we are owed 200 Rand for a service that we've performed. Some of that 200 Rand we will send to SARS, which means we'll keep maybe what, 170 or something. So that means when we then get that 200 Rand, I hope this makes sense, that 200 Rand is VAT inclusive. We are getting the money from the client plus the VAT. We are sending the VAT to SARS. Okay, so if we pay money, we also actually pay the money and the VAT. Okay, so any time we deal with money paid, received, money due, creditors, money receivable by debtors, we actually work with those figures VAT inclusive, because we pay or receive that full amount. And some of that full amount we're going to send to SARS, or we're going to claim back from them. Okay. So some of that, then, we put either into VAT input or VAT output. I'll stand still on this in a minute. I just want to finish the section on your slide. And the rest gets booked into the actual product or service or whatever we offered or bought. Okay, so used a couple of examples there. So whether it's stationery, sales, or telephone. Okay, so I'm going to stick with my numbers on the left just to illustrate this example one more time. So we have paid 230 Rand. Okay, we bought stationery. I'm going to stick with that example. So we swiped a card at Walton's, 230 Rand we paid for stationery. So we would all agree that's the amount I've paid. Okay, that goes into my bank. So I've lost 230 Rand. Okay, some of that 230 I'm going to be able to claim back from SARS. The reason why I know that I can claim back some of the 230 is because stationery is a standard rated item. So that's why your previous slide becomes important. If it was fuel, it'll be different. But because it's stationery, that's a standard rated item, it's necessary for business, necessary business expense, I can claim back 15 of the 115 of the total invoice price, which was 230. Okay, so 30 Rand goes to either VAT input or VAT output. Now, how do you know whether you use VAT input or output? If you are bringing it into your business, you have expenditures, you're buying something, it's VAT input. If you're claiming it back, it's VAT input. Okay, so any expenditures, purchases, any money that you've used or you're going to use in the future to buy things for your business attracts VAT input. Okay, because you are inputting things into your business, bringing it into your business, which means that 30 Rand from the stationery purchase, you're going to be able to claim back. So if I claim 30 Rand back from the 230 Rand invoice, what is the rest? That's what I'm saying, the rest. What is still on the invoice that's unclassified? 200 Rand. So the actual value of the stationery is 200. Okay, so I spent 230 at Walton's. 30 is VAT. 200 is stationery. Okay, that's what I meant with those two bullet points in blue. Money paid, money received, debtors or creditors. So whether I pay the 230 or whether I still owe it because I bought on account, doesn't matter. I owe Walton's 230. I paid Walton's 230. Same. Okay, that's the total amount that I owe. Of that 230, I'm going to get 30 back by putting it in the VAT column, and the rest is actually going to be classified as stationery or whatever I bought with that. It might be packing materials, it might be telephone charges, Okay, so your invoice will tell you what it is that you spent the money for. Okay, your VAT categories will tell you whether that item that's on your invoice is one of the items that you can claim back for. Okay, remember, it has to be standard rated, otherwise you can't claim anything back. Okay, so that's why this VAT breakdown of VAT inclusive, VAT, and VAT exclusive is important. This example might confuse you a bit, so refer to your textbook where they also unpack this. Maybe come back to my slides for a bit of a refresher and a second time hearing this. So that's why it is relevant, because there's money that we pay, money that we owe, money that we receive, but not, I always say, not all of that we get to keep. Some of that needs to go to SARS, and that's some of that is the 15% that we need to work out. But the rest also needs to be classified. So the rest of the invoice, the 200 Rand in my example, will be classified as stationery. Okay, so then quickly over to our source documents. So I just mentioned the invoice, the Walton stationery. Reminder about the source document section in your textbook. That is quite important for you to visually grasp what we are working with. Okay, also we have two methods to keep record of that. So these two sections I'm going to deal with together. So source documents, I'm going to deal with on the right hand side of the slide. Just firstly, on page 81, they deal with two different methods to keep record of your VAT in your business. Now, this has been such a popular question in assessments, and I sometimes think that students just completely miss it when they work through their textbook. So that's why I've given you an activity on these two methods. So please go and read page 81, and then you can do the activity on VC Learn. So you've got the payments basis, and you've got the invoice basis. Read the difference between the two methods and see if you can advise someone on the appropriateness of one of the methods that they want to use. Okay, so it's literally a method to keep record of your VAT. Okay, so that's what it is. You can choose one or two options, A or B. How do you want to record your VAT? Okay, so that's all I'm going to say about the two methods or the two bases to keep record of that. Okay, over to source documents. The reason why source documents is an important part of this chapter is because source documents show that. Okay, source documents show, I said in the previous learning unit 1, source documents give us the detail of a transaction that occurred. It's the paper trail. It's also then the paper trail for not only what I bought, but also if there's VAT applicable or not. Okay, so that's why source documents form a part of our learning unit 3. So they are the proof that we have a transaction. Firstly, we have a paper trail of the transaction. So yeah, I can show you, again, electronically or physically, this is what I bought. This is how I paid. This is the business's name. That's where they are registered. That is their VAT registration number, etc., etc., etc. You can read about it on page 82 and 89, exactly the requirements for different source documents. But different source documents are used for different transactions. So we get our own source documents for transactions. Not invoices, for example, aren't used for everything. Proof of payments aren't used for everything. It depends what your transaction is. But yes, your source document is the paper trail of what happened. It's important for us now because it tells us about the VAT. Okay, it gives us information about how much are we looking at in terms of VAT. So it helps us in a way with the bookkeeping of it. So what is the VAT amount? What is the VAT percentage? All of that we can find on our source documents. And you can scan through page 82 and 89 in your textbook, and you can see they actually have very nice examples of the different kinds of source documents. So you can go and just see, especially if there's ones that you've never seen before. I mean, we all use till slips regularly, and maybe you've gotten a proof of payment or a cash receipt before, but maybe there's some other ones that you haven't seen. So you can read in the textbook exactly what they're being used for and what they look like to familiarize yourself with them for the next learning unit. Okay, and then there's an activity of VC Learn, I think actually 2 activities that just, again, getting a bit more practical on the source document thing, so you don't just read over it, you can complete your own source document. The business's name is Kitchen Candy, so we'll be working with them quite a bit in Learning Unit 3 on VC Learn. and you are asked to complete a source document where they've made a transaction, and you can there get practical experience in terms of A, how to complete a document, and B, what information actually goes onto a source document, and how to do the VAT breakdown amounts as well. Okay, some of the source documents that you might come across in your textbook, you can see on this little diagram on your slide. Yeah, and you'll soon pick up exactly what kind of transactions attract what kind of source documents. Okay, this we are going to unpack, keeping in mind your invoice that you did for Kitchen Candy. Okay, so remember previous slide, I spoke about the Kitchen Candy business on VC Learn. Firstly, you were asked to advise them about the different methods in which they can account for their VAT, so the payment and the invoice basis. And then I said to you that for some practical exposure, you are asked to complete an invoice for them. Okay, so I'm hoping that you would have that in hand when I am speaking you through the section on the slide. I think it gets a bit much if you don't have something to refer to. Okay, so I'm trusting that you've done this invoice. Your lecturer can give you a solution as well to make sure that the template that you are working from is correct. Okay, and what I'm trying to do with this slide is just to bring everything together, because now you've done your own invoice. You've written out company name, address, the things that someone sold, bought, and the total rand amount. So what I'm trying to do is, if you look at that source document next to you, the Kitchen Candy invoice, that tells a bit of a story. Okay, so every source document really tells a story. I always say, if you understand accounting, we're obviously aiming that you would eventually move towards, you'd be able to look at a piece of paper, an invoice or a till slip, and almost be able to write like a word summary of what happened. Not because anyone explained anything to you, but because you are now, starting to speak the language of finance or the language of business, in terms of accounting and financial information and source documents and VAT and classifications of transactions, etc., etc. You should be able to take something like that Kitchen Candy invoice and almost tell me a story and tell me, okay, this is what happened. And that's how I'm going to classify it. You don't need anything else. Okay, and that's what we're aiming towards. So I'm hoping that you follow with me with your Kitchen Candy invoice. I think it's a very good test at this point in time before you move over to Learning Unit 4, which obviously takes it up another notch. Are you on the same page? Are we all on the same page? Do you see what I see when I look at that invoice? Okay, so that's what I'm saying. It's very important that you have the correct one in front of you. Please make sure that your lecturer gives you a solution or that yours is 100% accurate. Okay, so firstly, I'm going to start on the left of the slide. So the items in the invoice, bought or sold, was VAT exclusive. Okay, they were quoted to you without VAT. Without VAT means VAT exclusive, and that means 100%. Okay, and that means VAT needs to be added on to the 100%. Total invoice, 17,100. How do I add VAT? Times 15 over 100. Okay, equals 2565. So that's how I put VAT on to an item without VAT, by adding 15%. If I've added the 15%, the 2565, the total invoice price would be the invoice 17,100 plus the VAT that you've just worked out. Okay, so final invoice price 19,665. Okay, we spoke earlier about the breakdown when I mentioned the Walton Stationery example. So this 19,665 is not what the business is going to keep, remember. It is what they'll book in terms of money owed or money paid. But we now know that the 17,100 in reality belongs to them, if you want to say belongs to them. And the 2565 is actually SARS's. Okay, that's the VAT that's going to go to the South African Revenue Service. So the green section, I just want to illustrate how you can work with this invoice price in a different way and play around with the same numbers. So you have the total invoice price. Okay, for you to work out what is the VAT based off of that, multiply with 15 over 115. Okay, why 115? Because 115 is 19,665. Remember I said to you we work with 115, 115, and you need to know inclusive is 115, exclusive is 100. So play around with the relationship between the number 1, 2, and 3, VAT inclusive, VAT, and VAT exclusive. And that's what this allows me to do. I can take the final price, which is 115%, okay, 115%, multiplied with 15 over 115, and I get the VAT. I can multiply it with 100 over 115, and I get the exclusive price. Okay, and again, together, those two give me the full invoice price. Okay, I reminded you about my method below at the bottom where I say, remember, you multiply with what you want, you divide by what you have, the percentage now. So if you want 15%, multiply with 15%, divided by the percentage that you have. And if you have 19,665, you've got 115%. Whereas if you take 19,665, you want 100, you want the exclusive price, you want 100. So multiply it by 100, divide it by 115 because that is what you have. Not to confuse you, but you need to know very clearly, and that's why I said the relationship between 115 and 115 is extremely important. You need to know clearly what it is that you want. So do I want 100? Do I want 115? Do I want 15? And also know clearly what you have. Do I have 115? Do I have 100? Do I have 15? Okay. Because this multiply with what you want, divide by what you have only works if you know very clearly what you want and what you have. Okay. So just to look at this kitchen candy invoice in terms of, I want to say almost journal entry breakdowns, taking you back to learning unit 2 a bit with debits and credits. So what kitchen candy will book in as money received. Okay, they made a sale, is 19,665. So bank goes up, happy, you debit bank. You can see it at the bottom over here. Remember, we said every sale that we make, every piece of money that we earn, kitchen candy has to give 15% to SARS. But remember, the money that they receive is 115%. So 15 of 115, which is 2,565, they will end up giving to SARS. Okay, so we credit VAT output. We know it's VAT output because of the fact that we have to give it to SARS. We owe it to them on our output, which is the sales of our products. Okay, and then the rest, the balancing figure, we credit sales. Okay, take note, I don't want to spend too much time on the balancing of this, but you can see there are 2 credits, 1 debit. You can't do it like that. We just kind of merge the one bank. The debit matches the credit, which is a very important check. You can ask yourself based on learning unit 2, does this make sense that I credit that output? Yes, it does. It does go up. The liability increases. Credit sales. Yes, it does make sense. I have just sold more. Debit bank, does that make sense? Yes, I have received money. Okay, so again, just breaking this down one last time. I've received 19,665. 2,565 of that's going to go to SARS. The rest is actually my sales. Okay. On the same invoice, kitchen candy sold to Smith Traders. They, on the other side of the spectrum, they have just purchased something. Okay, for 19,665. So they bought something, money paid, 19,665. So their bank is going down with 19,665. They just spent money. It makes sense. They've paid everything to kitchen candy. They credited their bank. But remember, for them, for Smith Traders, this has been a purchase. So if it's the purchase of standard rated items, they can claim 15% back. Okay, you can ask yourself again, based on the VAT categories, is this a 15% standard rate item? In our indication in this example, yes, it is. So 15% of the 115 percentage, that is 19,665, which is 2,565, they can get back. Okay, so 15 of 115 of 19,665 they can get back. It's VAT input. They can claim it back. It is an asset. It does make sense that we debit it. And the rest, the value of our inventory is actually 17,100. Okay, we debit the asset that we just bought. Okay, so again, summarizing Smith Traders' purchase transaction one last time. We are spending money. We just spent 19,665, but luckily, of this 19,665, we are able to get 2,565 back by putting it in the VAT column, classifying it as VAT input. We are allowed to get it back. So the actual amount that we spent on inventory is only 17,100.